Hello everybody, today we start our lecture 3, which corresponds to chapter 3 from your textbook. The topic is financial statement analysis and long-term planning. So before we get to specifics of financial statement analysis, let me just explain to you the main idea. So remember we talked about financial statements, we now understand what kind of information is there, like balance sheet and income statement. The next step is to interpret that information. And financial statement analysis does just that. It looks at the information from financial statements and makes sense out of it. The way to make sense out of financial statements is to create some metrics, some parameters or indicators that will try to address various areas of performance of the firm. And that's where the ratio analysis comes into play. So it's like, again, the analogy would be a physician who received some blood work, okay? So the physician received the blood work analysis, okay? Now it's a job of the physician to interpret what those parameters in the blood work report actually mean. And hopefully that blood work analysis would help the physician to diagnose the problem with the patient and hopefully prescribe the ways to improve the health of the patient. Same is here in financial analysis. So we collect the raw data from financial statements, then we come up with specific metrics, specific indicators that address various areas of performance of the firm. We will talk about that in a moment. And hopefully, on the basis of those metrics, we could see what's wrong with the firm and also develop a plan about how to improve the performance of the firm. Okay? So the core of financial analysis is so-called ratio analysis. So basically, by definition, ratio has numerator and denominator. So there are various ratios that have various pieces of information from financial statements, but the key is to understand the logic between the logic with those financial ratios. So first of all, why is it ratio? Why not just raw numbers? Well, the idea is if you simply look at dollar values or raw numbers, you will not be able to compare between companies that have different size. Also, you will not be able to compare for the same firm, you would be able to look at the time series. So for example, if you have firm A that generated $1 million of profit, and you have firm B that generated $2 million of profit, sounds like firm B is better because it has more profit, but the question is, relative to what? At what scale firm A and firm B operate? Maybe firm A has a lot smaller scale, so $1 million profit for that smaller firm is much better profitability. Okay, it might have a lot better overall profit per dollar of investment compared to firm B. That's why we always need denominator. Okay, so if you simply look at raw dollar values, you will not be able to get the idea about how that performance is relative to sales, relative to investment, relative to equity, and so on and so forth. So we always need numerator and we always need denominator. Okay? So, excuse me. So, all right. So when you look at any ratio, so you have, x divided by y, for example. Okay? So first of all, you need to understand how the ratio is computed. So we need to know what x's and y's are. So for instance, if I tell you to calculate profit margin, as you will see later, profit margin has numerator, denominator, so you need to understand what they are. So that would be how is the ratio computed. So it's net income divided by sales. The next question is, what is the ratio trying to measure and why? Because again, you could come up with any ratio you want by yourself. You could just take, assets and divide by current assets. Turns out that ratio does not have any meaning. Okay, it's not going to be a good parameter. Now, if you do current assets and then you divide by total assets, well, at least it will give you the proportion of current assets in the total, but still, it's not going to be very informative. So the point is The ratios are there for a reason, and you need to understand what the ratio is trying to measure and why. You need to understand the purpose. Number 3, you need to know the units of measurement, and that could be confusing as well. Some ratios are just that, ratio. Some ratios are in percentages. Some ratios in dollars per something, let's say dollar per share. So you really need to understand what you're doing and understand the units of measurement. So whenever we consider a particular ratio, I will always, emphasize the appropriate units of measurement. Then you need to understand what does the value indicate. So is it good to have that ratio high, or we should try to aim it to be lower? For example, for profitability, we want it to be as high as possible, but for asset turnover, we want it to be as, for things like leverage, we might want it to be a little bit lower. Okay, although high leverage might also have its own benefits, but too much leverage might be detrimental. So for some ratios, higher values are more desirable. For other ratios, lower values are more desirable. And for some ratios, it's not even clear. Okay, for some ratios, high ratio might be good, low ratio might be good. It all depends on where you are compared to the industry standards. Okay, and finally, how can we improve the company's ratio? So that's also very important. So let's say we observe low profitability. What can we do to make it better? Or low liquidity. What can we do to make it better? And so on and so forth. So just like a physician, if I see low blood pressure or high blood pressure, what should I do to make the patient better? What kind of prescriptions should I write? What kind of drug should I give to that patient? Or maybe advise the patient to change his or her behavior. Okay, change the diet, exercise more. Same as here. You observe certain ratios, you see that the company is not doing well compared to the benchmarks. You need to be able to tell the company what to do. You need to help them with the plan. Okay? So with that in mind, let's look at various categories. So as I mentioned, ratios are organized in groups or categories that are logical. They make sense. Again, just like with medicine, medical profession, you have various systems of the body, right? You have cardiovascular system, you have neurological system, you have digestive system, and so on and so forth. The same is the firm. We try to divide the activities of the company or areas of the firm performance into various categories. So we have liquidity or short-term solvency, we have leverage or long-term solvency, we have asset management or asset efficiency or turnover ratios. Obviously, we have profitability, and we also have valuation, market valuation or market value ratios. So for each of those areas, we have a bunch of parameters, some indicators or ratios, and we cannot say which ratios are more important than others. We cannot unequivocally say that profitability is more important than liquidity. We cannot say that asset management efficiency is more important than long-term solvency. So the goal here is not to emphasize only one group of ratios. The goal is to understand all of them and try to improve as much as we can without hurting other ratios. Okay? So again, let's say somebody has digestive problems and also high blood pressure. Well, we want to fix both. We want to try to lower blood pressure and improve digestive system at the same time. Now, sometimes reducing blood pressure might actually hurt digestive system. So sometimes improving in one area may result in worsening in the other area. And that's where it becomes extremely tricky. We need to really understand how to balance between those groups of ratios. Ideally, you want to achieve something that's called Pareto improvement, when you can improve in one area without hurting any other areas. That would be ideal. So if I can prescribe a drug that can reduce the blood pressure without hurting any other areas of human body, That would be the perfect solution. So if I can improve profitability of the firm without hurting its liquidity, long-term solvency, asset efficiency, and market valuation, that would be a perfect case scenario. So we will talk about different ways to improve ratios. We will emphasize that sometimes improving one ratio might hurt the other, but again, the goal is to try to improve as much as we can without hurting any other areas of the firm's operation. So now let's talk about each of those categories one by one, explain the goals, and also talk about actual ratios within those groups. So before we do that, let's just put forward the data that we're going to be working with. So this is the firm balance sheet. We're going to focus on 2015. Okay, so all the ratios will be based on 2015 data. And here's my income statement. It's already 2015, right? So it's also 2015, so we're going to use that data as well. So whenever we calculate ratio, I will try to come back to this income statement and this balance sheet here to show you where the data is coming from. Okay, all right. So let's start with liquidity ratios. So first of all, before we get to specifics, what is the goal of liquidity ratios? We want to see if company has enough liquid assets to cover its short-term obligations. So the idea is if you do have short-term liabilities like accounts payable or notes payable, you need to be ready to have enough liquidity on your balance sheet to pay off those liabilities. Imagine a situation when a company borrows a lot short-term and then invests all of it in plant and equipment. Okay, so for instance, let me just do that. So where are my notes? Here we go. So let's say you have a very simple balance sheet, right? So let's say you have current assets here, and then you have fixed assets. That's it. And then you have current liabilities, you have long-term debt, and then you have equity. Okay? So let's imagine that the firm borrows a lot in terms of current liabilities, let's say 100, and only $50 in debt, and let's say $50 in equity. So your total sources of funding are equal to 200. And now the firm makes a decision to invest a lot in fixed assets. So basically, only $10 are invested in current assets like accounts receivable, inventories, and cash. The remaining 190 is becoming your fixed assets. Okay, so the total is still 200. So what is the problem here? On paper, the company does not look as bad in terms of insolvency. So we will talk about insolvency in a moment, but looks like equity is quite substantial, so the company is not really bankrupt. So in other words, if the company sells all of its assets right now, it should be able to pay off all of its liabilities, and it would still have enough equity. So the problem, though, is the maturities, the timing. So your current liabilities are equal to 100, but your current assets are equal to only 10. So what does it mean? It means that if within a month or 3 months or up to a year, the lenders will come, right, the holders of your notes or your supplier, and they ask for their money back, which they have the right to do, okay, you will not be able to pay back. Your current assets are very low. So the only way for you to pay back is to liquidate your fixed assets. But that's going to be devastating for the company, because if you liquidate your fixed assets, you lose the opportunity to make profits in the future. That's your core productive facility. That's number one. And number two, selling fixed assets might require taking a huge discount. You will have to sell those assets at a much lower price compared to their book value, because you're in a hurry, right? And the markets will understand it, and they will just try to get as big of a discount as possible. So usually selling fixed assets is a terrible, terrible idea. Another way to avoid the problematic situation is to try to extend your current liabilities. So what you're going to do, you can borrow short term in order to pay off your previous short term debt. So what you're doing, you just keep reborrowing. You're revolving your short term loans. Is it possible? Yes, but it's also quite risky. Because if you keep counting on credit availability and for some reason the market doesn't feel good and liquidity happens to be bad in the market overall, you will not be able to extend that loan. You might be okay for a few months, maybe for a few years, you can keep doing it, but at some point you will run into liquidity problem. And if that happens, you will be forced to sell your fixed assets. And that's again not a good situation. So, a much better way would be to try to match your current assets with current liabilities, at least match. So you don't want to have a huge mismatch between maturities of your assets and liabilities. So that's what liquidity ratios are trying to do. Liquidity ratios are trying to measure how do you balance the maturities of your assets and liabilities with the focus on current assets and current liabilities. So the first obvious ratio would be current ratio. So what it does, it just takes your current assets, and divides by current liabilities. Ideally, you want it to be greater or equal to 1. You don't want it to be less than 1, because if it's less than 1, it means that your current assets are not enough to cover all of your short-term obligations. So in case of our company, it happens to be equal to 1.31, so it's greater than 1. So the company is doing all right. Excuse me. So let me go back here. So let me show you how that ratio was calculated. So let's see. We have our total current assets right here, 708. So that includes cash, accounts receivable, and inventories. And our current liabilities are 540. So those include accounts payable and notes payable. Okay, and again, these are your all current assets. So we take 708, we divide by 540, and we get our number, which is equal to 1.31. All right, so looks like this firm satisfied the minimum threshold. It should be in a good position to avoid any liquidity problems. Now, the next step is to realize that not all of our current assets are particularly liquid. Some of our current assets may be, even though they are part of current assets, they are not very liquid. They're hard to liquidate. What is the most obvious candidate for low liquidity? Inventory. Okay. Inventory sometimes is the hardest to liquidate, especially if that inventory is a finished product that is not in high demand. If most of my inventories are raw materials, then it's not too bad. I can always sell raw materials. So if I'm making cars and I have a lot of steel and glass and plastic, I can sell it on, some exchange like Chicago Mercantile Exchange, for example, where the commodities are traded. So I can do that. I could sell it to someone else, maybe some other automobile producer or another company that needs steel and glass and plastic. So it's reusable material, so it's relatively liquid. And the price of those raw materials is driven by market conditions, so it's predetermined and liquid. On the other hand, if my inventories are primarily finished products, so let's say I produce some SUVs, but the gas prices are way too high now and nobody buys SUVs. So the demand is very low. So for me to liquidate all of those SUVs, I will have to take huge discount, and also people might not even want to buy them in the first place. Or maybe I'm producer of mobile devices, mobile phones. Let's say I'm Samsung. I'm producing cell phones, and it turns out that I have huge inventories of previous generation model. The new generation came out, the customers do not want to buy previous generation, so my inventory is not very liquid. On the balance sheet, it might look like It's part of my current assets for sure, but in reality, in practice, it may not be particularly liquid asset. So, if I want to be more conservative, and if I really want to measure my true liquidity, I would need to take inventory out of my calculation. So what I do, I subtract inventories from current assets in my numerator. My denominator is still the same, but my numerator now does not contain inventories. In other words, I want to see how liquid assets are relative to current liabilities, not taking into account inventories. And as you can see, suddenly the number drops quite substantially. It goes from 1.31 to only 0.53, which means that actually, if you look deeper in this particular company's situation, I would say that its liquidity is not as good because most of its current ratio is driven by inventories. Once you take inventories out, your so-called quick ratio is really, really low. Okay? And finally, you might want to go even more extreme and check how much cash you have relative to current liabilities. So that would be your cash ratio. And now all you do, you just take cash and you divide by current liabilities, and it turns out to be only 0.18. Now, this ratio is not very, it shouldn't be very high. So it's expected that ratio to be relatively low because companies try not to maintain a lot of cash. As long as they have enough cash and accounts receivable and maybe inventories, if inventories are liquid, they should be okay. Having too much cash means sacrificing opportunities because you will not be able to make money on it. So I'm not concerned with this particular company having cash ratio being low because first of all, we don't know what low means in this case. We always need to compare to some benchmarks, to some industry standards. So if you look at all of these three ratios, I would say that current ratios seem to be good. Cash ratio is not too important in this case, but quick ratio seems like it's on the lower side. But again, the key is always compare, always compare to industry benchmark. So what you do, you need to do some kind of peer group analysis. And we will talk about it a little bit later. I'll explain to you the idea of how to do the peer group analysis. But again, you just never look at company in isolation. You always need to compare to the industry because all these ratios will be vastly different for different companies across different industries. For example, if you look at a bank will have no current ratio whatsoever because bank does not have inventories, bank does not have accounts receivable. It will have a completely different ratio. There is no such thing as liquidity ratio for a bank, current ratio for a bank. Banks do have important liquidity ratios, but they are defined in a completely different way. On the other hand, manufacturing companies do have those current, quick, and cash ratio. Also, if you're a manufacturing company that relies a lot on heavy industry type of production like Boeing, they will have a lot of inventories because they would have steel, they would have glass, they would have all those ingredients to build all those planes. They might also have very expensive planes that are finished and not sold yet. So you always need to compare to similar companies in the industry. It's the nature of their business. On the other hand, if you're Apple, again, your inventory will be very low because you're not even manufacturing, you're outsourcing the manufacturing process. So your inventories are going to be extremely low, if any. Okay? So you don't want to compare Apple to Boeing. You want to compare Apple to a company that is, let's say, Samsung's division of mobile devices. Okay? And you need to compare Boeing to Airbus Industries. So those would be right comparisons. So that would be your peer group analysis or peer group comparisons. Okay? All right. So that was liquidity. So the idea is you just want to make sure that you kind of matching the maturities of your current assets and current liabilities. So you want them to be close to 1, preferably current assets being greater than current liabilities, and also not relying too much on inventories. The next question is your overall solvency. So now we are asking basically how much of financing of your assets are coming from shareholders. The more financing comes from shareholders or equity holders, the more financially stable the company is going to be. And the opposite is true if you have too much debt, right? If you have too much leverage, your company might be in trouble at some point, okay? So it's always important to look at, again, debt versus equity composition of your balance sheet. So the first obvious ratio would be your total debt ratio, which is equal to total debt divided by assets. And total debt, as you can see, is defined as simply total assets minus total equity. Okay? So in case of our company, your total assets are 3588, your total equity is 2591, and then your total assets are 3588. So let me just go back. So these are the numbers. So you have your total assets, okay? You subtract your total equity right here, okay? And then, of course, you divide by total assets, okay? So the total debt ratio equal to 28%. Again, is it good? Is it bad? There is no way to tell. Again, you need to compare to the benchmark in your industry. You need to understand the nature of the industry. If you are a bank, 28% total debt ratio is actually going to be very high. It's not normal. For banks, the total debt ratio is, a lot. Total debt ratio 28 is very low for banks. Their total debt ratio is going to be close to 90%, meaning that most of their financing is coming from borrowed money. And that makes sense because that's what banks do. They intermediate. They borrow money from people in the form of deposits, and then they lend money to people in the form of loans. So it's very normal for them to have very low equity, okay? Because they're intermediaries, they're middlemen, okay? On the other hand, if you're a manufacturing firm like Boeing or Apple, a Boeing or Tesla or Samsung or Hyundai, your total debt ratio of 28% might be absolutely normal. For them, having total debt ratio equal to 90 would be extremely high, and it would signal that the company is over leveraged, because that's not how their business operates. Okay? All right, so the next would be your total debt to equity. So the only difference here is denominator. So as you can see, the numerator is the same, but denominator is different. You just take your total debt and you divide by total equity. Again, 38.5%. Is it high? Is it low? It depends on industry standards. And finally, your equity multiplier, which is equal to your total assets divided by total equity, which is the same as 1 plus debt over equity. So how do you know? Let me just make sure that you understand how it's derived. So if I take total assets over total equity, now I know that my total assets are equal to debt plus equity divided by equity. All right, because by definition, assets are equal to debt plus equity. Now all I have to do is just divide through. So total assets over total equity over equity is equal to 1. And then I have plus debt over equity. So that would be my equity multiplier. Okay? Now, what does it mean? Why is it called equity multiplier? Hold on for some time. We will get to it a little bit later. All right? A little bit later in this lecture, we will explain the meaning of this particular measure, why it's called equity multiplier. For now, just, note to yourself that it's equal to 1 plus debt over equity. Anyway, whether you look at total debt ratio or debt to equity or equity multiplier, they all tell you the same story. The higher the amount of debt that you're using as a source of financing relative to your equity, the higher will be the debt ratio, debt to equity ratio, and equity multiplier. So you could think of all three ratios as some kind of measurement of leverage that the firm has. The higher those ratios, the more leverage the company has. And leverage could be a good thing sometimes because it can help you to boost your return on equity. We will talk about that later. But it could also be a very risky proposition. Having too much leverage may result in substantial risk to your shareholders. So we will talk about that later. But that's why these ratios are called solvency ratios. Now, so far, when we looked at solvency ratios, we just looked at balance sheets. Now let's look at income statement. So think about it this way. When you try to borrow money to buy a car, let's say, the bank wants to know two things. The first thing that the bank wants to know is how much debt you have already relative to your equity. And that's exactly what we did here, okay? Those leverage ratios. So leverage ratios show you your overall indebtedness, okay? How burdened you are with debt compared to your own equity, okay? But the second question that the banks want to know is, are you able to generate enough money on a regular basis to be able to service your debt? So if you decide to borrow more, right? So if I want to buy a car and I want to take a bank loan, the bank wants to know how much debt I have already, but also the bank wants to know if I'm able to make enough money on a regular basis, if my salary is big enough, so that I can keep making those interest payments. So that's the second part of solvency ratios, which is called coverage. Oops, just keep lying on me. It's called coverage ratios. So the coverage ratio just look at your overall earnings relative to your interest expenses. That's basically what it is. So that's the first ratio, which is called times interest earned. So times interest earned is equal to EBIT, earnings before interest and taxes, divided by your interest expense. So that ratio is coming from your income statement, okay? So my EBIT in this case is right here. So it's 691 and my interest expense is 141. Okay, so if I take the ratio of the two, I will get my times interest earned. Okay, so it's 4.9 times. So as you can see, the higher this ratio, the better, and that makes sense. In this case, the interpretation is the company is able to pay its interest almost 5 times if it needs to. Okay, so the EBIT is high enough to cover interest expense almost 5 times. So the bank should be relatively comfortable extending a loan to such firm because it sees that its pre-tax earnings are high enough to cover interest expense. Now, important question is why it's EBIT in the numerator and not, let's say, net income? Okay, so why wouldn't we want to have net income here? And the answer is very simple. Net income is calculated by already subtracting taxes and interest expense. We want to know how much money the firm generates before it pays interest and before it pays taxes, because that's where the banks actually get their interest money. A bank does not care if you have very high tax liability, for example, because the bank is the first in line. First, the bank receives its interest, then the firm pays taxes. So even though your taxes might be exuberantly high because your tax management policy is not good, and as a result your net income suffers tremendously, for a bank it doesn't really matter because the bank is the first in line and then the taxes are being paid. All right? Similarly, why would you want to look at income after interest? You want to know it income before interest is paid so that you know how much money the company has to actually pay that interest expense. So that's why you have EBIT and not net income. Very important. Okay, now you might ask a logical question. All right, so if all I care about is if company has enough cash to pay interest expense, why don't I convert it to cash basis? And that's exactly what cash coverage ratio does. The cash coverage ratio looks at EBIT plus depreciation. All right, so it's EBIT plus depreciation. So why we add in depreciation? If you remember, the operating cash flow, right, from the previous lecture is equal to EBIT plus depreciation minus taxes. Okay, we just established that we don't care about taxes in this case. So basically, EBIT plus depreciation is pre-tax operating cash flow. And that makes sense if I'm a bank and I want to know the company's ability to pay interest. All I need to do is just to look at its pre-tax operating cash flow, and that's going to be EBIT plus depreciation. And again, looks like the company is doing pretty well. It has that ratio equal to 6.9 times. So as you can see, if you look at accounting earnings, the company is almost 5 times capable of paying interest expense. But if you do it on a cash flow basis, it's even better. And that makes sense because depreciation is a substantial write-off, which does not have anything to do with actual cash payments. So yes, on cash basis, it's even better capacity, even better ability to pay interest expense. Okay, so the next group of ratios is called turnover ratios. So in general, okay, so let me write that down here. In general, turnover, let me call it X turnover, is equal to sales divided by X. Okay, so X means type of asset. So for instance, total asset turnover would be equal to sales divided by total assets. Inventories turnover would be sales divided by inventories. Accounts receivable turnover would be sales divided by accounts receivable. And finally, fixed asset turnover would be sales divided by fixed assets. Okay, so that's a general rule. So the question is, why do we care about turnover ratios in the first place? Well, think about it this way. So let me give you an example here. So let's say you have firm A, and then you have firm B. Okay, so let's say firm A has assets equal to 100 and firm B has assets equal to 200. Okay, so if you simply look at assets, looks like firm B is just a bigger company. Okay, all right, that's fine. Firm B is just a larger firm based on the amount of assets. But what if I told you that firm A has sales equal to 1,000, while firm B has sales also equal to 1,000. Now, if you look at it carefully, you will realize that having twice as much assets, firm B is not able to generate any more sales than firm A. So from that perspective, firm A is actually a much more efficient company. And that's going to be the general theme with all of those turnover ratios. You want to make sure that the firm is able to utilize its assets in the most efficient way. And by utilizing assets in the most efficient way, we mean being able to generate as much sales as it can, as much sales as possible, and being able to do it equally well than the industry standard, if not better than industry on average. Okay, so in this case, your gut feeling, right, your intuition would tell you that firm B is worse than firm A, that somehow firm A is doing a better job. So how can you quantify it? Well, you calculate asset turnover. So asset turnover for firm A is going to be equal to 1,000, which is your sales, divided by assets, 100, and that would be equal to 10 times. Again, you need to watch the units of measurements, not 10%, 10 times. Okay, So, all right, then asset turnover for firm B would be equal to 1,000 divided by 200, and it's only 5 times. Okay, so firm A is much more efficient. So let's think about it. Why it might happen? Well, the most obvious would be just overinvestment in assets that are not productive. So you could think of some kind of excess capacity. Perhaps firm B invested a lot in fixed assets like plant and equipment. It built a lot of production facilities, but it really underestimated its demand. So a lot of that capacity is just idle. It has plant that is only operating at 50% capacity, while firm A was smart and they invested less in assets, but they're still able to generate the same amount of sales because their assets are operating at full capacity. So clearly, firm A is more efficient. So that's basically what those turnover ratios are going to tell you. Okay? And I just gave you example with mainly fixed assets because it's the easiest to understand. But it turns out that before we calculate our total asset turnover, we could break it down into 3 separate asset turnover ratios: inventory, accounts receivable, and fixed assets. So let's start with inventory turnover. So inventory turnover would be sales divided by inventory. Now, on your slides and in your textbook, you have cost of goods sold divided by inventory. The reason why it's cost of goods sold and not sales is because in accounting, inventories on the balance sheet are reported on the cost basis, not on the final price, but the cost basis. So to be consistent, right, since inventories are reported on the cost basis, in the numerator, instead of looking at sales, which is final price times quantity, you look at cost of goods sold per unit times quantity. Okay? Now, I don't care if you do cost of goods sold divided by inventory or instead you do sales divided by inventories. In fact, some analysts actually do that. And in fact, even in some textbooks, inventory turnover is defined as sales divided by inventory. It doesn't really matter because if you do it consistently across different firms, which you are comparing, whether you do cost of goods sold or sales, it's not going to really matter relatively. Of course, sales divided by inventory will always be higher than cost of goods sold divided by inventory because of the price difference. But again, if you compare company A versus company B or company A versus industry average, yes, in absolute terms, sales over inventory would be a little bit higher than cost of goods sold divided by inventory. But if you compare relative to your benchmark, that should not make much difference. Okay? So it's up to you how you're going to do it. We might want to stick with what the textbook does and do it on a cost basis. But the bottom line, regardless what you have in numerator, you want this ratio to be as high as possible. Okay? And here is why. Think about it this way again. Everything else equal, right? Do you want to have your sales? Let's just talk about sales because cost of goods sold will be correlated with sales anyway. Do you want to have your sales as high as possible while inventory as low as possible, or the other way around? And the answer is yes, you want this to be as high as possible and this to be as low as possible, because it means that you're not stuck with your inventories on the balance sheet. You're not stuck with your money being tied up with inventory. So think about it in the extreme case. Ideally, you would like to have zero inventories, meaning that everything that you sell, everything that you produce, you immediately sell. You immediately sell. You have no stock of inventories. You don't sacrifice any opportunity to make more money. You don't need to worry about keeping those inventories, storing them, paying some insurance premium, making sure that eventually they are sold and perhaps taking discount in order to sell them. So you don't need to worry about any of that. So the most efficient companies, the ones that have very high demand and also the ones that have very good sales forecast. They will try to minimize inventories while maximizing sales without accumulating inventories. So everything else equal, you want your inventory turnover to be as high as possible. Okay? Now, related ratio is something that's called days sales in inventory. So all you do, you just take 365 days and you divide by your inventory turnover. And the number that you get now, the unit of measurement is in days, so 114 days. So how do you interpret that? Think about it this way. Given your average inventory balance, it will take 114 days to sell off those inventories completely. And this ratio you want to be as low as possible. So again, inventory turnover, you wanted to push it up. Days sales in inventory, you want to push it down. And that makes sense because it's pretty much the opposite ratio. Okay? So which companies would have, high inventory turnover? The first important, so let me just do it this way. Let me write that down here. So how to improve inventory turnover. So number one, you need to have better sales forecast. Okay, so one of the main reasons why companies accumulate too much inventories is because they miss their sales forecast. They overproduce, they produce more than they expect to sell, and that will result in buildup in inventories. But number two is more efficient supply chain. Supply chain and distribution. Okay? Because another reason why companies might have excessive inventories is because they have to buy a lot of raw materials in big bulks in advance because they're not connected well with their suppliers. Okay? And that's why some firms, in order to improve their supply chain efficiency, they strategically locate their production facilities close to their suppliers so that they don't need to stock up on their supplies in advance, and instead they buy raw materials on as needed basis. That way they're able to just buy raw materials, quickly transform it to finished product, sell it, and they're not stuck with inventories. Because remember, a big part of inventories is raw material. And similarly, the distribution. If you distribute your products very efficiently, when the product goes from production facility to your final destination customer very quickly without a lot of storage, okay, your inventories will also be lower. That's actually the reason why Tesla is so efficient, because their distribution bypasses a lot of dealerships. There are no stores, there are no real warehouses. They just produce their product and then they immediately deliver it to the customers. Okay, so their distribution chain, the way they distribute their product is much better compared to your regular automobile producer. So anyway, you want inventory turnover to be as high as possible, and you do certain things to do that. The next one is accounts receivable turnover. So now, as you can see, you have sales in the numerator. There is no ambiguity here. It's not cost, it's just sales divided by accounts receivable. Again, 12.3 times. Is it a lot? Is it a little? Well, it will depend on what the industry standard is, but you want this ratio in general to be as high as possible, just like with inventories. And the logic is very simple again. Everything else equal, would you rather have low accounts receivable or high accounts receivable? Well, everything else equal, if I'm able to maintain my sales, I would rather minimize my accounts receivable, because it means that I don't lend to my customer. I'm able to sell everything for cash and immediately reinvest and make money out of it. The higher the accounts receivable, the more you have to wait before you get your money back. And remember, in finance, time is money. The longer you wait, the less opportunities you have to reinvest that money in something more productive. So you want your accounts receivable turnover to be as low as possible. And related ratio would be days sales and receivables. So you just take again 365 divided by receivable turnover. And in this case, it's equal to 30 days. So what does it mean? It means that it will take 30 days to collect your accounts receivable. So you want this ratio to be as low as possible. So what are the ways to improve accounts receivable turnover? Well, number one is maximize your cash sales. So maximize cash sales, or alternatively minimize your credit sales. Sometimes it's not easy to do. Sometimes the only way for you to actually increase your sales is to increase credit sales. But remember, we are not talking about changing anything else. We're just saying, given your sales, is there anything you can do to to increase your accounts receivable turnover? And one step to do is just to increase cash sales compared to credit sales. Sometimes it's impossible to do, but if it is possible, it's absolutely something that you want to do. Number two is improve your customer, screening and collection policy. Okay, so number one, maximizing cash sales is related to not extending loans to your customer in the first place. So when you maximize your cash sales or reduce your credit sales, you say, I will try to avoid credit sales in the first place. Number two, on the other hand, addresses another concern. Once you made that credit sale, you want to make sure that you make it to customers who are credit worthy. So you basically improve your customer screening, make sure that they don't default, because normally your accounts receivable start getting bigger when your customers don't pay back on time. So in other words, it's called aging. It's called aging of your accounts receivable. So you don't want that to happen. And also collection. So not only you want to make sure that you don't make loans to bad customers, but also you want to make sure that in case customers are not paying on time, you're collecting, you're trying to put some pressure on them so that you collect your money in time. Now, of course, within legal framework, you don't want to run around and start beating people to give you money back. So obviously it's illegal. But improving your collection policy, meaning that, maybe you send more reminders to your customers. Maybe you sell your accounts receivable to collection agencies earlier than you normally do, and so on and so forth. So the bottom line, you want to increase your sales without necessarily adding to your accounts receivable. Or alternatively, you want to keep your sales at the same level but reduce your accounts receivable balance. All of those actions will allow you to increase your accounts receivable turnover. And finally, you have your fixed asset turnover, which is sales, again, divided by fixed assets. And in our case, it's equal to 0.8 times, so it's less than 1. Is it a problem? No, not necessarily. It just means that your sales are lower than your total amount of fixed assets. Usually, it happens when you have very capital intensive production. Example would be, Boeing. So for them to make one plane, they need a lot of fixed capacity. So what happens, even though if they make 10, 20, whatever, 100 planes a year, I'm not sure what the number is, still it might be less in terms of your sales volume, it might be less than their overall value of fixed assets. That is normal for that industry. On the other hand, if you're Apple, your fixed asset turnover is going to be huge because their fixed assets are very low, they don't even produce anything, but their revenue is very, very high. So you don't want to compare Apple to Boeing. You want to make sure that you compare, apples to apples. Okay, so fixed asset turnover being less than 1 might be perfectly fine for that particular industry. Now, how do you improve your fixed asset turnover? So how to improve fixed asset turnover? Well, the most important thing is better capacity utilization. Okay, so what does it mean? Well, if your fixed asset turnover is very low, it might indicate that you just have excess capacity. You have too much plant and equipment and it's not operating at full capacity. Remember, General Motors, right before the financial crisis of 2007, 2008, it was a huge company. They ended up selling a lot of their brands. They ended up downsizing. They ended up selling some of their plants in the US and abroad. And now it's a much smaller, much more focused, but also much more efficient firm. So prior to the crisis, they had too much capacity that was not utilized properly. And as a result, they had extremely low fixed asset turnover. And as you will see later, it also contributes to low profitability. So you don't want that. You want to utilize your capacity in the best possible way, so you want to use it efficiently. So if you observe low fixed asset turnover, you want to basically try to investigate the ways to load your capacity, utilize it better. So how can you do it? You either increase sales so that you can utilize capacity at 100%, or you simply reduce your capacity. Okay, so if I have idle plant, I either load it and try to find some business for that plant, or I get rid of it. Keeping it idle will hurt my balance sheet and it will hurt my earnings and it will hurt my shareholders eventually. All right. So finally, you have your total asset turnover, which is just your sales divided by your total assets. And in this case, it's 0.64. Again, it's less than 1 in this case because assets seem to be dominated by fixed assets, so it's not surprising for this particular firm. And it should not bother you as long as it's normal for this particular industry. Okay, so just to summarize, asset turnover ratios just show you how efficient you are in managing your inventories, accounts receivable, and fixed assets. And they all contribute to your total asset turnover, which is sales divided by total assets.